All right. Good morning, everybody. Like we discussed the other day, after the Fed has their quiet period and then they go into FOMC, when they come out, they take a few days off and then they hit the media. And what they're really trying to do, it seems, a lot of times, is cement something that Powell had said, right? He comes out chipping his teeth, better or worse, maybe chews on his foot a little bit. And then they have to kind of play cleanup mode. Um, they're trying to solidify the message and then beat the drum over and over to kind of get it out there, right? And while each one of these people are individuals with their own agenda and their own points of view and their own context, they will continue to sing from the same hymn book, right? They'll continue to try to spread whatever message it is that they're trying to spread. And we can see throughout today that we have a lot of speakers on deck, and one of them is Powell himself. So he's going to have an opportunity today to perhaps push back against the way the market responded to his FOMC speech from last week. We'll see, right? And yesterday I talked about how near the end of that presser, they asked him a question on why does the market seem to believe that you're going to pivot while you're still saying you're not going to pivot. And he basically said, I'm not going to try to convince anybody if there is or isn't going to be a pivot. I've said what we're going to do. I've continued to say what we're going to do, and we're not going to pivot. Now, he couldn't say they were going to pivot, even if they were going to pivot, because the market would explode higher. And I don't know. Is he trapped in a situation where he knows at some point we're going to pause and he just can't say that? Or is there no pause? Well, if you look at the job numbers that came out last week showing historically low unemployment, and that's just one data point on top of others, that it doesn't look like they've resolved this issue. But it goes even more beyond that, as this chart kind of shows right here. So this is the total assets for the Fed. You can see, what they're carrying since COVID, and they're trying to sop all this up. God, it's a long ways to go. So today we've got a lot of speakers. Want to keep our eye on FX Street, Finance Jews, whatever your news place is. Even think or swim, you don't really have to leave the platform. It has this thing called Market Flash, Trade Flash, excuse me. And under Trade Flash, if anything comes out headline wise of significance, it would show up here. It's not going to give you, like word for word what Powell is saying or what any of these other speakers are saying. But, they're the main takeaway could very well be posted in that trade flash. We're still seeing Google and Microsoft have this little public battle. It really isn't a battle at all. It's just the hype, right? They want to get people with their eyeballs on AI and AI products, and they're doing a really good job. Everywhere I look, somebody is focused on, AI. Google's response yesterday was Bard. Pretty interesting. And that brings us into AI tokens. A couple of really small AI companies out there that, man, their options, I was looking at them yesterday, their options were just absolutely horrible, but their share cost wasn't that bad. So, when liquidity is soft or basically non-existent on an options spread, what I tend to do is go farther out in time, and then I like to stay on the sell side a little bit more, right? That way, or at least run singles, not spreads. So, buying a call or a put, selling a call or a put, not really doing spreads. When liquidity is junk, doing a spread can be difficult to get into and even more difficult to get out of, especially if it's going against you. We're really looking for guidance from Powell today. When he's doing the FOMC, his hands really are tied on how far he can deviate. I think today he's got a lot more freedom. And I believe that that freedom, for good or bad, might be, the clarity that we've been looking for. So I was under the impression that he was going to speak at noon, but if you look at Thinkorswim, go to Market Watch, check the calendar, it has him listed at 12:40. So I'm not sure now. He's going to be there. I'm not quite sure when, right? So you'll know it because when he starts talking, finance juice will light up with these big red, kind of alert style. I love that, right? You can't miss it. So energy equities gained in Europe in the later part of the day. Well, I mean, it's 12:30 now, so in Europe, so it's not like we're too late in the day. So they kind of cover it right here under the European market wrap. Following January's strong payrolls data and comments from other Fed officials regarding the prospect of higher peak than policymakers had previously anticipated, we are now evaluating whether Powell will reduce market anticipation for interest rate decreases later in 2023. So we're all looking for guidance on what the Fed is going to do in the later part of the year. The idea was if the target rate is 5.25 and we would get to 5.25 by June, then we would have to pause in third quarter, and by the fourth quarter, maybe even start pulling some off. And what the Fed has continued to say is we're not cutting in 2023 at all. That ain't happening, period. And as for a pause, our mythical, hypothetical unicorn slightly restrictive rate was supposed to be around 5.25, but so far the data is showing that they're not restrictive enough. And so 5.25 might not be restrictive enough, and they might have to go beyond 5.25. So we're really looking for that guidance. There are a few things that will affect this decision. One of them is going to be this aluminum tariff. The White House is kicking around the idea of putting an aluminum tariff on Russia. And if they do that and jack the price of aluminum up, well, it's going to raise the cost of everything else, including electric vehicles, but a lot of other things, right? Aluminum is in all kinds of things. So it's that's an inflationary event, putting a tariff on aluminum. If China continues to reopen and that increases their fuel use, whether we're talking crude, gas, whatever, if they're using more energy, energy costs are going to go up. Again, inflationary. So those two events alone are seen as inflationary. Then here in the US, they're talking about ending that policy where the border anybody seeking asylum or trying to cross because of the COVID restrictions had to wait in Mexico. They couldn't wait in America. They're going to be looking to end that policy. And for anybody who lives in the US, if you look around, the amount of people that were here before COVID and then during and after COVID, there's a big difference. If we start seeing people come back that disappeared during COVID, that is going to help with the sticky wage inflation. Hopefully lowering that a little bit. I know we all want the higher wage, right? I want to be paid more. But it's the sticky wages and people jumping from job to job to chase after the higher wages and having to do sign-on bonuses and everything else that is helping keep all these costs up. So if we can get wages to drop down, it helps with that sticky inflation. So at least out of the three things we just discussed, solving this COVID restriction that was put into place, and it was supposed to be time lapsed, right? It was only supposed to be for a certain period of time and then it falls off. Well, that should be ending soon. That would be a good data point. We have additional auctions today, the 4-week and the 3-year. The 3-year is at 1 o'clock. It'll be nearly the last econ of the day. This consumer credit has been known to provide a little bit of volatility, but more often than not, it's kind of shrugged off. If you're ever unsure about one of the econ that is coming out on the day, one of your go-tos would be FX Street. They have this little gauge or meter showing the severity level of previous reports, right? So if we kind of scroll down a little bit and we're looking for that 3 o'clock consumer credit, you can see that typically it doesn't have a lot of impact. And that doesn't mean that it can't, right? It's just that more often than not, when it's reported, that one doesn't seem to cause waves too often. So it's worth looking at. It's certainly worth keeping your eye on, being, at least prepared for a move, but I wouldn't expect too much, especially since the market's probably still going to be responding to whatever Powell does today. Of all the days to do a 0-day, this is one where you might want to tread with a little bit of caution. There's days where the juice just ain't worth the squeeze. Yep. Now, having said that, we have been waiting for Powell to get through this all that sideways activity yesterday was a hurry up and wait on Powell. And if you think about how the market moved after FOMC, where we really didn't get much follow through, right? We had that 1-day wonder, and then we kind of topped out and we faded back, and now we're just kind of holding the range. The market's looking for clarity. And if they get it today and get this decision made, they'll now have a direction, right? It's kind of like driving around aimlessly because you really just don't have anywhere to go. But once you've got an idea of where you want to go, you start motoring, right? You start moving in that direction. So that's kind of the idea today, that by the time he's done, unless he just really muddies it up, by the time he's done talking, the market should have a very clear idea of what it wants to do and where it wants to go. It's either going to start pricing in those pivots, or it's going to start unwinding those pivots that it's already priced in. Either way, it should be clear and it should be obvious about what's going to happen next. And we're going to be looking on the two simple pivots somewhere around 4,000 and 4,200. It's a very clear, very simple range. We're going to look for an upward push to challenge the 42, or we're going to look down to challenge the 4,000. I don't see how it can get any more clearer than that. And just keep in mind, we still have March FOMC. So this morning, the volume is a little light, kind of implying what we've been talking about, that the market knows there is something on the deck. There is something worth waiting for. And if we didn't know, right, if we just showed up this morning and hadn't looked at the news at all and hadn't looked around the world, the volume alone would tell us something is going on. The market is waiting here. That's why we use this. We don't need it this morning. Just turn it off. So we are range bound, Captain Obvious. It is a very narrow range between yesterday's high RTH and yesterday's low. Very clearly, you can see that we're inside of it. And even if we were to break out of it, the actual full high of yesterday is only a few more points higher, right? We're talking about going from 41.35 to 41, call it 45, another 10 points, right? Not much more to the upside there. The 50% line in the sand that we've been using is 41.05. That's 50% of Wednesday's price, basically. And I'd mentioned it the other day, we need to close above that level, right? If we're going to remain bullish. And so far, I mean, we faded down and we tagged it a couple times, but we're still holding above it. The market maker move is not really big this morning. It's interesting that it's there. They haven't really started to wind it up much yet. It's a little more than 0.25%. So if we add that to the 1.5%, which is our average daily range at the moment, we're looking at 1 3/4. I got to tell you, the market doesn't move 1 3/4 as often as it moves 2% or 1.5%. So it's much more likely that we would move beyond 1 3/4 and would hit 2%, much more likely than we would just stop at 1 3/4. So with that in mind, since the ADRs don't cover that, we would want to take the market maker move and add it to the 21-day ADR and just mark out that 1 3/4% move. Or what I'd rather do is measure the whole thing and give that 2%, right? And a 2% move would put us right around 40-40. It's not spot on perfect, but I like that round number, 40-40. Easy to remember, all that good stuff. So we'll just put a little line in the sand down there. And the same thing from the other direction. A 2% move in the other direction actually gets us right up to that Thursday's high, the previous week's high, really, when we think about it. So we've already got a line there, 42.08, really close to that 42.11 cog line. All right, so we are tangled up in a daily and a weekly pivot. Those aren't really helpful today, other than the fact that we've hit them, which is like, okay, so yep, we hit them. The Globex open from last night is really close to the RTH open of the previous day. They're really close together. I would look at them as a zone rather than as two individual pivot points. And what we really want to see today is leaving the range. Well, the range to the downside is pretty obvious. It's that 50% mark. It's 4104. We break to the downside below that. We got an air pocket. We should just drop right on down to that 2% move at about 4040. Really clean, really clear to the downside. The upside move, on the other hand, still has to travel through all of this trash. So once we get above, say, 4150, right, we get that gap closed, then we've got all of this trash to deal with from Thursday and Friday before we finally get above all of that and have some clear sailing. Every once in a while, I talk about an indicator called the fractal Laguerre, RSI Laguerre. There's a lot of moving parts and pieces to this thing. You can find it in the Thinkorswim workbook, along with like 4 videos and pictures showing different signals that it can give. The cyan line is a 2-period RSI. If you were to go back and study, the creator of the RSI, at some point he decided that a 14 RSI or a 13 RSI is great for what it does, but he wanted something that was like all or nothing, where it would magnetize across the top or the bottom. And he set it to 2 periods. Well, if you bring up a 2-period RSI, it doesn't have that clean magnification where it just sticks to the bottom or sticks to the top. A 2-period RSI looks like choppy seas. I mean, it's just all over the place. So a bit difficult to use. What this thing has done is it's been smoothed out, where for the most part, it really does stick to the bottom or stick to the top, unless it's transitioning across. It was not meant to be used on a 15-minute chart, but if we get out onto the higher time frame, you can see how once it gets down there, it just sticks, or once it gets up there, it sticks, it magnetizes and stays there. And we really aren't looking for any of it in the middle, right? We could just basically ignore those. And the other line that's in here is this orange one. That orange one is what they call gamma. It's not options gamma. It's more of a just a phrase than anything else, but it's energy. And what they've come up with on this thing is that when a market is sitting sideways, what we call consolidation, digestion, it's got a lot of different words for it. It's actually building up energy. Energy is a word that we don't often associate with the marketplace. Doc Severson brought that up. He wrote a book on this thing. He's done classes and webinars and all over that, right? He's like the guy when it comes to this thing. His word is energy. And when the orange line is sitting at around 60, then you've pretty much got a full tank of gas. You've got a lot of energy. You're ready to go. The reason that it matters is if you think about when a market is moving and we get to a resistance point, does it have the energy to break through it? The analogy that I always use is throwing a ball to somebody, right? If I go out in the yard and I throw a ball with my kid, I'm the one throwing the ball, putting the energy behind it. And as the ball moves, it loses that energy. It dissipates. And at some point, it'll hit the ground because it just ran out of juice. You take a ball and you drop it off the top of a very tall building. You didn't even have to put any push behind it. Just let it go. It's going to pick up energy as it goes. So when something is moving, it's not always moving, burning energy behind it. it's moving to get energy. It's actually getting energy because of the move itself. And this indicator can kind of help us identify if the move is being done with energy behind it, or if the move is being done and it's getting energy because of it. It's an interesting concept. Not a lot of indicators out there that have this sort of perspective, right? Usually it's trend, momentum, inertia, rate of change. Part of the formula for this is actually honestly rocket science, which I thought was kind of funny. And the other part of it is a indicator called the choppiness index that was built in like 1970 something. So it's a transformer hodgepodge of a bunch of different parts and pieces. And I'm a thinkorswim coder. I don't understand half the code that's in this thing. The good thing is we don't have to understand it. We only need to be able to understand the lines out here. So we are wound up, fully loaded. We've got a lot of energy behind it. All we need to see is this market make the move and start dispersing that energy, using the energy in the move. $10-day, 30-minute volume profile. We didn't set this thing back to where it belongs. Ah. When we're at the bottom of the box, we expect to go to the top. When we're at the top of the box, we expect to go to the bottom. We managed to find some stability yesterday, even though we had dropped down through that 40-20 area and came into this air pocket. We still managed to not hit the bottom of the air pocket. I was kind of surprised about that, honestly. But a lack of participation has to be basically the only thing that saved us yesterday when it came to not making it all the way through the air pocket and hitting the other side. I'm not really complaining. You know, it's nice to have a few days where we're not moving around so the ADR can drop a little more. Point of control is 40.35. There is a lot of trash that starts right below 4,100. So, you know, getting to 4,100 shouldn't be that big of a deal. Getting past that and moving towards the point of control where there's all this trash to deal with. Within the next 2 days, we should see the reduction of this lower area of price, unless, of course, we revisit this area in the next day or two. So at that point, the profile will drop even more, right? It would be this 200-point range at that point, right? We'll have lost all of those candles in the next 2 days or so. So the profile is getting more and more narrow. It's not a bad thing necessarily, but the more restrictive we see price, the more we don't move around, the more nervous I get about a big move that's coming. And we're going to go look and take an eye at skew here in a moment, which will kind of give us a gauge on how the rest of the market feels about this reduction in price movement. So we still have the VPOC that we brought in yesterday around 41.50, and the lower one is still in place from just about 40.80. So we got one on each side. The lower one is absolutely what I'm going to target should we break below yesterday's low. I'm aiming right for that VPOC. For the upside one, it's going to be a battle all the way up through all of this stuff. And I think that one minor little point of control is going to be nothing more than a speed bump. I don't think it's got the gumption to slow this thing down at all. We've nearly made it back to the 0 line, which means we've almost made it back to the 10-period moving average. That will be the reset that we've been looking for. $42.30 is the top side of the weekly expected move, and $40.62 is the downside of that expected move. Just getting to the edge of the box, maybe even getting outside of the box, it's not really a big deal. But if we moved 2 standard deviations, then the algos are going to kick in. And if it's the upside move, if we get around 4,300, they'll buy into that buying. They'll begin to actively hedge and buy into the buying, trying to get back to delta neutral. The more that they buy to get to delta neutral, their buying forces the market to move even higher. And it becomes a vicious little feed loop that the more they buy, the more it moves higher. And the more it moves higher, the more they have to buy. And the more they buy, the more it moves higher. Same thing to the downside. 39, call it 39.78. We get 2 standard deviations somewhere around that line. They'll sell into selling in the same vicious little feed loop. We're really close to where we ended on Friday, so we're really close to being in the middle of the box. We haven't even begun to test either edge, but by the end of today, I have every expectation that we will be outside of this box. Maybe I'm putting too much weight into all of this. Maybe he's going to come out and actively try to talk without doing anything, which is what I usually call Operation Don't Rock the Boat. It's possible. So the third scenario, since we know price can do anything that it wants, is that we actually don't do anything today. That perhaps we see a little bit of violence through the day from him talking and from everybody else that's going to be talking. And we see a little bit of fractal, a little bit of shaking, rocking, rolling around. And at the end of the day, we're still sitting in this zone well within the boundaries of 41 and 42. So, as much as we talk this up, it doesn't have to do anything today. For the most part, the 4 indexes are similarly aligned. The Russell certainly looks weaker than the rest, right? If we look at the lows of yesterday, from Globex, RTH, all of it, from the lows of yesterday, the Russell is still near those lows, as opposed to, say, the Dow, which set the low in the Globex yesterday and has really expanded away from it considerably and held the line quite well, right? It's holding above its 20-period daily moving average, while the Russell is trapped underneath its 3 and is a long ways still away from that 20. If you look at the S&P, it also set that Globex low, but then revisited it in the middle of the RTH yesterday, and we're still sitting on the upper edge of all of this. So it's certainly looking better than the Russell, but not much better than the Dow. And then with the S&P, or with the NASDAQ, nearly a triple touch across the bottom. It's still in the upper edge afterwards. So of the 3, these 3 are really similar, and the Russell's kind of the odd one out, which makes sense because it was doing better than the others, right? So it has more room to fall. VIX has basically been flat through the overnight. Dollar retesting highs of yesterday, looking for an inside day breakout, which we didn't get yet. but it keeps knocking on the door. And the phrase is persistence beats resistance. So if it persists in kicking the door, it's very likely the door is going to open. Bitcoin sold off considerably. We got below 22.8, or we got down to 22.8 yesterday, managed to bring it back up to 23.1. So some pretty wild gyrations, but in the grand scheme of things, nothing compared to what we've seen lately in Bitcoin. And crude is maintaining that inside day breakout from the overnight hours, but it's still underneath the 10 and the 20. So it managed to get back above the 3. It's a good start. It's got to hold it and prove it. We still got 10 and 20 to deal with. The move in the 10-year was kind of a little bit of a surprise yesterday. We tested the edges for a breakout. We never really got it, but we had opened gapped up to begin with. So a significant gap up, and it just kind of stuck and held at that point. We want to see how we open today, and really keep your eye on that 10-year. There was a good article that came out on US dollar Japan, and there's no way I'm going to try to pronounce the anticipated new guy that's going to be taking over. But they do have a name that has kind of floated to the surface, and he's the same he's in the same party or the same camp that believes in the yield control that they've been doing. So for all of us who were thinking that maybe we were going to see Japan finally get away from that yield control experiment that they've been running for like a decade, the name that popped up is someone who really believes in that same system. So it's likely that we don't see any real significant change in the policy of what's been coming out of Japan. We still don't know for sure. And until we get through the backside of March, that threat still looms. So something to kind of continue to keep your eye on over there. Any article that you come across that is discussing, the what Japan is going to look like after all of this is said and done, it's worth a read. Try to familiarize yourself with the players in that space. Good luck with the names, by the way. I'm just saying. I butcher a name when it's Mike and Joe and Bob. Goodness, I'm not even going to try to pronounce that person's name. One of the direct effects of looking at US dollar Japan is how it will impact the US in relation specifically to the S&P. Not the NASDAQ as much, but the S&P itself. And in relation with the dollar and with the TNX. When we're looking at China, a lot of times the correlation that we look at goes directly to commodities. Or if we're looking at Canada, the direct correlation would be to oil. So every one of these, at least in a tangent way, connects to these other things that we're talking about. So with US dollar Japan, it also directly connects with gold, like an inverse market, like a teeter-totter. So US dollar Japan continuing to fade off from that really big move from last week. That move up smacked gold to the downside. Gold is expected to do really good through 2023. So seeing it take, a good pullback is an opportunity to get in. But it's not going to be a straight shot, and it's not going to be an easy hold. It's going to be, choppy and difficult. Still, all the gold bugs and all the gold signals and indicators and, everything that we've got says gold's expected to trend well through 2023. And that this would be an opportunity in this pullback to catch it. But a note of caution, the pullback in gold was vicious. It went farther than, technical analysis said that it should go. So it was a steep pullback. On the one hand, that's not bad, because if you're not yet in gold, getting it lower is a good thing. But if you were already in it and you're trying to, sustain the ride, so it'd be a little rough. So as you can see, that was a pretty steep pullback. It was kind of due for a pullback, right? We'd had a reasonably decent run, 30 points, nearly 21%. That's nice. So a nice pullback. We could break outside of the previous week's low. I wouldn't like it, but we could. As long as we're maintaining above 168, we're fine. Getting in as close to that line as you could would be great. We burned all the energy off in the move. We still need to regain energy, and we're getting a J hook down. Something to consider. The move up off of these lows was a textbook J hook with fully loaded gamma. If you go over to the Thinkorswim workbook and you search for fractal energy or the RSI, you'll see pictures that I've taken that show this J hook with the high gamma as the signal for a move like that. Isn't that pretty awesome? Same thing back here. J hook, high gamma. There's your move. So likely to see a little bit more digestion. We kind of ran out of energy. Just keep in mind that a market can move to gain energy. It doesn't have to pause and consolidate to gain energy. We know that when it does pause, that's generally where we gain energy, but we can also gain it by moving. So, more often than not, what that means is that a pullback generates energy. That's what we're seeing right there. It pulled back sharply, and that increased the energy sharply. So a little bit of a line in the sand, somewhere around 70, 170. And then some chop, maybe some sideways action to gain up a little bit more energy before making another run back up at that 180 plus. Speaking of gold, it's what has sizzled this morning. Got a mild squeeze. And reasonably decent market maker moves are lined up on a lot of these gold names too. Also, Bitcoin And oil and gas in a bit of sizzle this morning. So they're the ones getting flow. Yeah, thanks for that. In the chat, someone just shared Tom McClellan's point of view on gold. If you don't know Tom McClellan, his family is a part of, if you go to stockcharts.com, there's these charts called the McClellan Summation Index. You can get it on the NASDAQ, the New York Stock Exchange. Pretty amazing stuff. He's like, I don't know, second, third generation trader. I haven't heard his whole bio yet, but the name itself should stand out, right? If you haven't come across it before, it's worth checking out. Absolutely. All right, sorry about that. I had to hit pause for a minute. So I shared that link that was shared in the Zoom chat, and I put it into the YouTube chat. If you want to go over and take a look at what Tom McClellan has to say on gold. Now I'm on a weekly chart, and we're starting to see the very first green candle this year. Kind of say it that way. It sounds a bit more ominous than I meant it to sound. Yay, we're getting a green one. It don't count yet, right? The week's not closed, but it's a good start. So far, knock on wood, we've found a little bit of stability around that 822. It's a historic level, right? We can see back to the last time we were at that spot, and that it was also the bottom back then too. I don't know if this is the bottom. It hasn't built a base yet. It hasn't even proven that it's going to hold this low and not go lower yet. And I am already in it because I found a low risk opportunity. And when it's low risk, it's basically, you know, like, why not? So I've got a position off of these lows. But we all have to kind of come to terms with our risk that we carry, right? If your rules say that you need a signal or a setup or some kind of confirmation, we don't have that yet. We do have WTI and Brent crude here. We had talked about this lower trend line getting broken. Just kind of roughly throw it on there. We're now coming up into the underside of it, right? This is a bounce off of support with a rally into resistance. So really something to keep in mind, right? Even though, you know, we are making a move to the upside, it is a rally into resistance. on Brent crude, it just wicked through and came back up. So it's already above it and would actually need a steep trend line across the top here. We'd be looking at this point for a TRB, trend line breakover. So a bullish trend line breakover would get us around 85 to start with, and it would owe us back to the highs somewhere around 87.5, maybe 88. But if you're looking at WTI, a rally into resistance is likely. If we were to ignore the angled trend line on that and just put the overhead line on, this really steep trend line, we'd be looking for the same thing, trend line breakover, a very steep TRB. Those can have explosive follow through, a TRB, a trend line breakover. The thing is, right now with this one, is that we're trapped in the February 3rd candle, that really big down day. Until we get out of that, any sort of follow through has to be taken with a grain of salt, right? It's going to be either getting in without having made the breakout or waiting for it to break out. And at that point, we're halfway through the move already. So I don't like it. I don't like it on either end of that. We have 100% an indecision candle on Hong Kong or the Hang Seng index. We're still sitting inside of yesterday's price. Managed to hit the top, fade right back down again. The FTSE 100, we're still open in Europe. It's 130 over there right now. Inside day. But the day's not done, and it does have the capacity to break out. I just don't see it happening without some kind of news or catalyst. But as we come into 10:30 today, our time, their market's going to be wrapping up and closing for the day. So we want to see how they close, and we want to see if they get a fire sale going into their close. Right, so it's like power hour for us. Only just dial it down to a 30-minute time frame from 10 to 11. Excuse me, from 10 to 10:30. That'd be the last 30 minutes of their trading day. So with the Dow, we've got this wedge really setting up. And we're kind of in the middle between the high end of this range and then the low end of this range. So a little bit of a make or break moment. Don't diddle in the middle. In the S&P, however, you can see that breakout from 4106, and now we've got this Busby shape to it, right? We broke out of the zone. We broke out of that range, expanded above it, came back now, and we're at a key inflection point. 50% of February 1, the FOMC day, Wednesday last week, is our line in the sand, but it also lines up with this previous pivot point. It also lines up with this angled trend line. So if we break inside of that 50% mark, if we come back inside of this zone, we're going to be looking for a TRB to the downside. There really isn't a whole lot of reason to go through the individual names, looking at the fangs and seeing what they're doing, because we're all going to be waiting on Powell today. Everything is sitting inside that big candle. Just a whole bunch of hurry up and wait. So keep your eye on Powell. Watch the news today. Looking for his comments, and just follow it up with anybody else who happens to be talking, right? It was a pretty good sized list. So a lot of data points coming out of, a lot of perspectives, not really data, but a lot of perspectives going to be coming through today. Everybody be careful, be safe. Have a good day, and I'll see you all tomorrow.